before ever entering another trade, I want you to have this in mind, because this can change everything for you. So guys, in this video, I will show you how you could have predicted a picture perfect trade down here. You would have entered here at these lows, and you would have most likely exited this trade somewhere up here for a potential move of 160 ticks. With the same principles, you could have also pretty much perfected and found a perfect entry up here, and potentially even down here, but this is unfolding right now, so we're gonna take a look at this a little bit later. But for now, let's take a look at how you could have found this picture perfect entry down here. And this, guys, the principles that I will teach you inside this video, they work every single day in the market. They work no matter what time of day it is. So you can trade before your workday starts, after your workday is over, or maybe even during your lunch break. It doesn't really matter. Whenever you open up your laptop and you have some time to trade, look out for these few things that I will teach you in this video. And this can change, hopefully, a whole lot in your life. Because once you know how to find entries like these, trading can become effortless. And this is what this video is all about. So let's first take a look at the overall situation, and then we'll get right into the entry signals so you can predict entries like these down here. So overall, you can see that the market started off right here. Yesterday was Labor Day, so it was a holiday, no real trading opportunities there. But for now, let's take a look at what is happening. We can see that the market has been going down, up, and it's kind of trading in this range. Then we broke out of this range right here to the downside, and now we see an extensive move all the way down here. So entering a long trade down here is counterintuitive, right? Because you're trading against the trend, and you shouldn't trade against the trend, right? Right? Well, depends, because once you know what you're doing, you can trade against the trend. And I will show you exactly how this works, because it doesn't have to be complicated. You first need to understand a few key principles. So if you would take a look at all of these candles, and I'm going to make this very clear for you guys, maybe potentially even all of these moves, then you will find one thing very obvious. Take a look at this move here, or take a look at this move here. Take a look at this move down here, and then a slightly bigger move all the way up here. However, all of these things have one thing in common, right? The length of this move. For example, here from 442 to 405 roughly, they're all kind of the same. The length is always the same. The average true length is pretty similar. Okay, and then for the first time, we see this move, so a bit more extensive. We go back up, similar once more, right? We go back down with this super extended large move. Guys, what is this? Very simple. This is an abnormality to the market. This is not normal. This right here, that is normal to the current state of the market. Okay? This move right here, this huge move to the downside, is an abnormality. It's not supposed to happen. And you can take advantage of these abnormalities once you know where to look. And this right here, you could have seen that coming a long time ago. And I'll show you why. And then I will show you exactly how you can actually find the perfect entry. Okay? So first, we have the first signal of, hey, this could be a potentially interesting situation, which is an abnormality to the market, a very extended move. Imagine a rubber. If you pull the rubber a little bit, it goes back quickly, right? Or slowly, I'm sorry. But if you extend the rubber extensively, you pull it a long way, what happens? Boop, the market goes back rapidly. So once we have an extended move in the market, you can expect, if you enter at the right point of time, a very quick move up to the upside, which is exactly what you like to see. You want to get in on your trade and you want to get out a couple minutes, a couple seconds later, in and out. That's what you like to see. Once trades become They take time. Then you know you're in a potentially difficult situation, to be fair. The perfect trades go quickly, okay? So this is your first entry signal, and abnormally to the market. But where should you now look for an entry? Should you look somewhere here? Should you look somewhere here? Or here? And why is this the perfect level? For that, we take a look at previous market locations, previous levels of market acceptance. Because what you need to understand is the market has one primary goal and two sub goals. The primary goal is to transact as many contracts as possible. So if you take a look at how the market works and actually understanding of how the market works, we can see that using the volume profile, we have traded somewhere up here at the beginning of the day, meaning these prices at these price levels here, they were accepted. Market participants said, hey, these prices are fine and we want to transact here. But at some point, the market participants said, no more. I don't want to trade here anymore. This price is too expensive. So the market went lower and decided once more, even this area right here is too expensive. We need to find another price level that is actually being accepted, that is fair for today. And that was somewhere down here. And you can always predict these levels very easily, actually, with previous market levels of high volume. But for now, just understand, if the market wants to transact as many contracts as possible, and it cannot do that up here, it also can't do that here, but it can do that here. We know lower prices are being accepted. Okay, cool, but that doesn't mean we can now find a perfect entry just based on that information. We just now understand why the market moves down or up or in a balanced way. That's why this happens. Okay? The good thing now is you will soon learn in just a couple seconds where the market can transact as many contracts as possible. The first level is at levels of liquidity. So let's take a look. If you would take a look at how most retail traders trade, and you can see this just perfectly here today. We can see what they call support and resistance. So take a look at these lows right here. Beautiful, right? Beautiful. What is this for a retail trader? This right here is called support. And what do retail traders do at these levels? They buy, they buy, and they buy. Where are their stop orders? Down here. So right here, there's a bunch of sell orders. Also, people who want to look for a breakout, they might want to get stopped in somewhere here once this level breaks. So what is below this level of support once more? Well, even more sell orders. So this is sell liquidity. And somewhere, most likely at the nearest high, we can see here, or actually quite a few highs there. Beautiful. Take a look at this. This level right here. 2 highs, another one here, and a couple here in that range. Meaning, what is above this level? There's buy liquidity. Okay, down below, there's sell liquidity. Up here, there's buy liquidity. The market now, if the market wants to go down, if the market says, hey, these levels here are not good anymore, we need to lower the price because we cannot transact as many contracts as possible up here. The market, most likely, and I have a bunch of videos on this on my channel, so check that out if you want. The market grabs this liquidity and then whoop, goes back down. Where does it go? Below this level, right here, it comes back once more. This is usually what happens. So if you would take a look at this range, and I'm going to make this actually very easy for you. This is a principle that works quite often, to be fair. You would just mark out these two, this low and this high. And usually what happens is once you break out of this range, the market at some point comes back near the 50% mark. So right here, it didn't come back all the way. It came back around like 40%, but still good enough. Okay. So now the market grabbed this liquidity down here. It grabbed this liquidity down here as well, came back, and then it broke out. Beautiful. Where did it break out to? And how can you now predict this? Well, let's take a look at previous market locations, because that is the second key area where the market wants to go to. We have levels of liquidity and levels of previous market acceptance. So let's take a look at the volume profile, and we're going to mark this level right here, and it will become so obvious now. Now, if you take a look at that market situation, so we would have been right there. So that is the current market situation. You would think, hey, the market's just selling off. I'm not going long here. No way I'm going long. Well, think again. Extended move. We grab this liquidity up here. We have a strong move to the downside, but it would actually make sense to go long here. And here's why. Take a look at this. And we will combine a whole lot of things together in this video. And soon you can also make entries like these, hopefully. So take a look at this. We don't see any levels of previous market acceptance up here, right? So this is all pretty much dead for us. But then here we can see, hey, wait, something is going on. Somewhere in this level, take a look at this. We have one high volume node. We have another high volume node here. So meaning we mark these highs right here. This is a level of interest. The first level of high volume, a second level of high volume. Obviously, we have another one here. We can now extend this actually somewhere here. And now we see this is where the high volume started. And high volume just means the market accepted these levels in the past. So now in the present time, the market can make a move at these levels. It can go further down. It can go back up and have a support level there. It doesn't really matter how you interpret that things. It's just a way of, hey, let's take a look at what the market is doing at these levels to find a potentially good entry. So we have these levels here. We obviously have another level down here. But for now, let's focus on this because it will become so obvious for you guys. So in the current market situation, you're now sitting in front of your charts and you're seeing the market going right at these levels, What do you think? Well, I might want to get ready for an entry. Because this could potentially be a nice level of an entry, of a long trade. And here's why. For that, we switch over to Bookmap. And I brought this exact situation for you guys here. Now, Bookmap, in case you've never seen that, is just a way of looking at these candles in a different way. So obviously a candle is just, for example, in this case, it's a 5-minute candle. You see the high, you see the low, you see the open, and you see the close, right? But you don't see what's happening inside these candles. Was there aggressive buying, aggressive selling, passive buying, passive selling? How was the auction quality? How was auction speed? All of these things. And in case you've never heard of these, you're in for a very nice treat now. So this is the exact market situation right here. And let me just make sure we're actually on the right level here. So this is 4 a.m. right here. So this is most likely 3:55. And let's check. This is 3:50. So I'm going to show you exactly what happened here. You can see lows, lows, lows. And then boop, the market went back up. Interesting. So it's this exact situation. Lows, 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 and then whoop, the market went back up. But how can you now predict that? So we know that at this level right here, which is 270 roughly, we know that the market has a level of interest there, somewhere right here. That is a level of interest. So the market came down all of this way, and we already know this is an extensive move. This move is an abnormality to the market, which is already beautiful. So you combine a level of interest with an abnormality to the market, which is an extended move in this case. You already have two confirmations that, hey, this could be a potential entry very soon. Counter trend, doesn't really matter, but this could be a very nice level to enter a trade very soon. what do we see? We can see that the market went fast. And how can we see this? Well, take a look at how it looks here compared to here. This is fast. The market is just dropping. Here it's going slow. So the angle is way, way different. And every time you see this fast move right here, that is called auction speed. However, auction speed can also be combined with auction quality. So for example, this right here, the speed is extremely high because we move so many price levels within a very short amount of time. So we went from 311 to 284 within a matter of seconds, most likely. However, here, same amount of time. So let's say this is like 1 or 2 minutes, most likely 1 minute. Here we only went from 279 to like 289. So 10 points. Compare these moves. There's no comparison. It's a completely different move. Slow auction speed, high auction speed. Bad auction quality because we only see moves to the downside. You only see red bubbles. Red bubbles only. Bad auction quality because the market always wants to buy and sell. And here you see a better auction quality. You see some buying, but also some selling, especially if you zoom in a little bit. You can see here, it's just a mix, okay? We have selling, we have buying, we have selling, we have buying, selling and buying. The bubbles kind of look the same, meaning the size. This, by the way, is aggressive buying. This is aggressive selling, okay? And we can see it's just going back and forth, back and forth, back and forth. Good auction quality, okay? So we can see this extensive move down with bad auction quality, which is already a sign for reversal. So some people would say, hey, I'm going in here because this move is already super extended and here we can see some buying coming in. Guys, no, don't go in here because, and this is very important now, we still have some levels of liquidity down below. You can see this liquidity here, you can see this liquidity here, and you can see this liquidity here coming in here. You don't want to go in a reversal trade in case there's still some liquidity below, actually nearby, because liquidity is a magnet to the market. So we come down below and you ignore everything that happens until we come to this level of interest. And right here, we see something interesting. And that is where you potentially get active, potentially. You can see that for the first time, we went through all of this liquidity. The market came down below, some more liquidity here. We also grabbed this liquidity. And for the very first time, we can see that somehow the market went to our level of interest. And now the market went back up and we had a shift in liquidity. For the first time, take a look at this. There was no liquidity above, right? There was none. And then suddenly we touched our level of interest and now liquidity is coming in and it's moving higher. Liquidity is coming in above the current price and liquidity acts like a magnet to the market. And once liquidity comes in above for the very first time, that's a bullish sign. And there's about 8 different things that you can look out for inside Bookmap. And I'm just going to show you a few obviously today which you can use to predict a picture perfect entry. But what else can we see? We can see right now at least the market went down and we had this huge order here and this huge order here, meaning every time the market, and this is actually so simple, guys. So let's actually take a look at exactly how this works. You can see the order book here, right? On the right hand side, you can see the order book. So you have 3s here, 3 here, and 3 here. Meaning, if we buy 3 contracts at the 286.25, once all of these 3 contracts that were on the ask are bought up, the price should technically move up, right? It should move up because there are only 3 sellers. And once we bought these 3 contracts, we should go up, supply and demand, to the next price level. But what if this doesn't happen? So for example, here, you can see 42 contracts that were traded. Or here, 29 contracts that were being traded. Yet the market didn't go further down. Interesting, right? Interesting. The market didn't go further down. If you take a look at that exact situation, we can see, and I'm going to zoom in so clearly for you guys. We can see here, we had roughly, take a look at this, 2 orders on the bid, but we traded 25. So about 10 times the size of the order book was traded. 10 times the size that was in the bid was traded here, yet the market didn't go lower. So what does that mean? It means someone is passively buying up all of these contracts. Okay. And this happens not only once, but it happens. Let's take a look. Once more, another 25 contracts. Interesting. So 50 contracts traded at that level, even though the order book only had a couple contracts in there. So someone is passively building up a position of potentially 50 contracts or more. So for now, you have 2 options. You either get in here because you already see a couple of things. You already see an absorption, and that is what that's called. You already see a move of liquidity, and you can already see that we touched our level of interest. We had an extended move. Auction quality was extremely bad. We worked through all of this liquidity, and then there's no more liquidity down below. We worked through all of it that was nearby. We worked through all of it. So the market can now be, it can be exhausted. The market can be exhausted at that moment. You see an extended move to a level of interest. Bad auction quality, bad auction speed, or very fast auction speed. We work through all of this liquidity, meaning the market did a lot of work to get there, and at some point the markets go up and down the whole time. If you just went up, at some point a move up is very likely, right? So you could have already predicted a very nice entry somewhere here. However, this is not where you want to go for a very long position, because something else will happen very soon. For now, you might go in here for a very quick scalp. So I would go in here on the 71s once we touched our level of interest, because I know there's no more level of interest right down below. So this could potentially be my level of entry. And once I see, to be fair, I would probably go in here, because you also want to see a change in market structure. A change in market structure is lower highs, lower lows, lower highs, lower lows once more. But for the very first time, we make higher lows and higher highs. So once this level here breaks, this high, you see a change in market structure at a level of interest. We see buying coming in for the very first time. Compare these buying bubbles with these. They get bigger and bigger. Then you go in for a quick scalp. Where is a potential exit? Most likely somewhere here, potentially even somewhere up here, to be fair. However, this right here would have been the perfect entry most likely. So you get in on the 74s and you just get out at the 80s. About 30 ticks, done, you're out, okay? With 1 or 2 or 3 contracts, potentially more, could be already a very nice trade. But if you want to go for the master trade, for the perfect trade, you wait until here. Okay, what do we see? We see that we absorbed a bit more, but some liquidity is coming in down below. So the chances of us taking this trade and actually being successful, I don't know. But once we see the market is trading up once more, and then at our level of interest, we had a previous level of absorption, meaning someone was buying up all of these contracts, but he probably couldn't buy up any more contracts at these levels without moving the price himself. Because just imagine if someone is willing to buy up hundreds or thousands of contracts, okay? We have this range, okay? And he wants to, at this price area right here, roughly on average, he wants to buy up 1,000, beautiful one, 1,000 contracts. If he would just buy 1,000 contracts at one point, what happens to the market? The market shoots up. So he needs liquidity, guys, to buy 1,000 orders. And if he knows, or once he sees a bunch of liquidity down here, he sells quite a bit down here and then buys a whole lot of contracts on here. So he pushes the market lower with a very large sell move to the downside. He gets himself out of his own position and then buys all the liquidity down here, okay? And that is what it's called stop fishing. Stop fishing is exactly what you see here. We go right below these lows, just slightly, with extreme speed and extreme bad auction quality. You see quite a bit of buying coming in, passive buying coming in once more. He bought another 29 contracts right here. And then somehow the market moves up. Interesting, right? So the perfect trade would have been you being patient in this situation. You see a low forming. And just like this situation, just like this situation, you know, hey, every time we have a range, which is an accumulation, okay, once we accumulate at a level of interest, usually what happens, guys, is a manipulation before distribution. That is usually what happens. So you can get in here for a very quick scalp. You could go in here for a high risk scalp, to be fair. You might have actually won this, to be fair, but I wouldn't recommend the second entry. But once you see this range forming, you will know, or you should know now, we are level of interest down here. Most likely there will be a manipulation at some point, which is exactly this. Okay. And then you can get in for the perfect entry. And once you're in here, maybe in here, you could also wait for a change of market structure once more. So for example, if we zoom in quite a bit, you can see here, boop, and then higher highs, higher lows, just slightly buying coming in. So this could be a potential entry. In case you couldn't have gone in at this level, the market would have pulled back quite a bit, then get in here once more. That is your entry. So at the 73.50s, somewhere down here, you would have found your entry, guys, with this level of market understanding. And where should you get out? Well, let's take a look. In terms of the volume profile, we can check. Do we have any levels of interest somewhere here in this area? So anywhere from here, most likely, and I'm going to remove everything actually. So we got in our position somewhere here, 73s. And we know that the move started somewhere up here. So that will become support, will become resistance. At least that's what the retail traders want to tell you. So the ultimate move would be a move all the way up here. However, in between these two lines, there will most likely be some high volume. And that high volume can become resistance because market participants accept these levels and transact there quite a bit. So somewhere right here is a high level of volume. We can see if we find some more. Look at this. Some very nice rejections here, also there. So this is very beautiful already. And that looks good to me, to be fair. That is the last level of high volume there. So we check. Okay, so that's at the 18s, 18 to 23. So I would go ahead and I would check, and I enter my position right here, right? So right here, I enter my position. So I would now check at the 23s, and I wouldn't see all of this to the right-hand side yet. Okay, so I would go somewhere in here, and I would check where could I actually exit this, and I would see this range obviously for now. So a potential exit could be here at the top of this range at 91. So somewhere here for a quick scalp, get in here, get out there. That's about 80 ticks. Beautiful trade. But if you want to make some more money, and we're here to make some money obviously, we want to check what is going on at that level of interest that we just marked. And that is the 18th once more. So we take a look, and then we see here, somewhere here at the 18th. We can see here a larger order and a pullback to this level at the 16th already, 16th to 18th roughly. Okay, we could see some previous liquidity here, even here. So already at the 99s, because there was a large order and some liquidity, I would be cautious at the 99s. I would be cautious once more at the 10s roughly. And my ultimate goal for now would be to go out at the 16s. And within 5 minutes, I have the benefit of hindsight here, obviously. You get in here, and at our level of interest, let's see what happens. We see the market turn around. Guys, whew, that was a lot. I know. That was a lot. It was a bit of a unstructured video. I know that. A lot of knowledge here. A lot of things that you might have never heard of before. If you want to go deeper, feel free to reach out to me. I can help you maybe understand all of this in more detail. But this right here could have been a trade that you could have predicted perfectly. Perfectly. You could have had the perfect entry, but also the perfect exit. By simply understanding levels of interest in combination with all of these things that we can read inside Bookmap. Liquidity, large orders, auction quality, auction speed. Strong lows, weak highs. We didn't get into that, but maybe for another video. Whew. Guys, I hope you like this video. I really do hope that you like this video. I hopefully can play some very nice trades later on today. Without further ado, I'll see you guys in the next video. Leave a comment. In case you have any questions, feel free to reach out to me on Instagram or just in the comments down below. And I'll see you guys in the next video.